is in the same
in the credit cost.
In the credit
line.
cost.
So it is netted off in the credit cost line.
Okay, sure. Secondly, what is the BT out rate for FY24 and Q4?
So it's in the range of 6 to 7%. Our overall closures have been 16.7% in the year. BT out used to be higher. If you compare FY23, it used to be higher. In FY24, it has come down. So now it will be in the range of about 7%.
Okay, sure. And lastly,
on a YOY basis, BT out has come down by 10%.
So from in absolute terms or in percentage terms? So,
in absolute terms.
In absolute terms, okay. And lastly, if you look at the cost of funds, since your incremental cost of fund and book cost of funds are broadly similar, so cost of funds should not inch from here onwards. Despite that, you are guiding for around 15 basis point compression in margins from Q4. So which means that we expect further moderation in yields in FY25 versus Q4?
See, when we give guidance on NIM, we are looking at slightly long term. So what I'm saying is margin will be in the range of 3.5%. Now, given the fact that a lot of performance metrics have improved over last few quarters, especially in last year, and also the rating upgrade by 3 agencies from AA to AA+, we are expecting the cost of borrowing to come down. And moving to high yield segments and restart of corporate. So all of these things will ensure any drop in the yield because of book attrition, especially on the prime.
Sure, sure. Thank you. That's it from my side.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Hi, thanks for taking my question. Just wanted to reconfirm, so the benefit of rating upgrade is not something that you're building in your margin guidance, right?
To a certain extent, we are building in because rating upgrade we got the upgrade recently. So we are building in the benefits of rating upgrade. So all I'm saying is that because of corporate, because of book depletion, especially on the prime book, that would be compensated by new segments which will give us a higher yield, and also the benefit what we can see on cost of borrowing because of rating upgrade.
Got it. But in last 1 month, in your conversations, what is the benefit that you are seeing right now?
No, it is too short a time. This will take about a quarter or so. So we are negotiating with all the bankers, and we are trying to figure out how we can try to bring down the cost to various instruments. So I think this effort is on. So we expect cost of borrowing to come down because of the rating upgrade and implementing performance metrics.
Sure. Just on the emerging markets, business, these are basically, into interior India. So these markets will already have some other lenders, or would you be the first lender in these markets?
So these markets would have lenders already.
But then do these lenders, like maybe, the larger banks out there, do they really differentiate in terms of the rate of interest between the larger and the tier 1 and tier 2 city or whatever?
Yes, there will be differential. Even today, the kind of business what we do, for us, the lowest book in terms of yield, is about 60 to 70 bips higher than the yield of most of the banks. So even today, the differential is there in prime book only, in prime markets only. So in emerging, this is going to be slightly higher. Within our segment composition, this would be about 50 to 75 bips higher than the prime yield.
Got it. Just on the ECL coverage, we have been consistently increasing it. So are we comfortable at these levels, and specifically, in stage 2 where, we had a slippage in the corporate segment?
No, we are pretty comfortable.
Sure. And just one last question, which is a little topical at this point of time. In terms of, anything if you could share, in terms of the audits that happen, with the regulator. and if that has happened for the year, and if there is anything notable that you can share on that.
So, there was an audit by the regulator, and we have discussed the initial observations. So there's nothing serious in nature, and we are still awaiting the final confirmation from the regulator.
Got it. And this will be NHB or RBI?
This is NHB.
NHB. RBI doesn't audit you at all, from a regulatory point of view.
So given the structure, for policy framework, it is RBI. For supervision, it is NHB.
Got it. Thank you very much. All the best.
Thank you.
Thank you.
We'll take our next question from the line of Dikshit Doshi from Whitestone Financial Advisors. Please go ahead.
Thanks for the opportunity. So basically my question is, if we compare ourselves with, let's say, Canfin Homes, our book is kind of double of what they are doing. So, but if I see our employee cost, it's like more than 3 times. It's around 3x. So, what is the reason for that? Is it because our earlier focus was predominantly a prime business, or is there a lower utilization of our branches? Or so basically, I wanted to understand, because their name is also kind of similar, 3.5 to 3.7%, and with a similar credit cost. So if you can broadly, help me understand what is the difference between us.
I wouldn't be able to compare between one other company, but just to give you a context, the name which you mentioned, for us, that is going to be emerging vertical business.
Okay. So basically, just wanted to understand how we'll be able to, improve the ROE.
See, ROE today, it is slightly muted because of the drag of rights issue. With improvement in performance metrics, if you must have seen, the journey in last few quarters, last 5 to 6 quarters. So as of now, there'll be a drag because of capital raise. I think in about 3 years or so, I think we should be able to look at reasonable ROEs.
Okay. And can you just mention how much typical employees per branch in, let's say, prime, affordable, and emerging?
So in affordable, we would have typically a branch would have a branch manager, we would have a credit manager, and we would have a ops resource, and we would have some executives to source. The same model would also be on the emerging. On the prime side, depending on the location and the potential, the branch staff could vary between 4. Some of the bigger branches will have more, but those are few in numbers.
How many you said? 4.
Some of the smaller branches will have 4 to 5. Some of the bigger branches may have even 10. That depends on the location and the potential and the business what we do.
Okay. And if you can just repeat the recovery number you mentioned in the Q4.
Q4 recovery was 49 crores. From the return of pool, it is 49 crores for the Q4.
49 crores. Okay. That's it from my side. Thanks.
Thank you. We'll take the next question from the line of Viral Shah from IIFL Securities. Please go ahead.
Hi. Thank you for giving me the opportunity. So, actually, a few questions. One, first of all, did I get it right? Your growth guidance for FY25 is 17%.
Correct.
If I may, what is stopping us, given that we are pretty, I would say, levered at a lower end of the spectrum? Is the market opportunity not out there to grow faster, especially given that you are getting into some of the sub-segments and the geographies where you would now have a pricing power?
There are 2, 3 contexts. One is we want to grow profitable book. That is one, and that is the reason why we moved towards affordable and emerging. So if you see incrementally this FY25, 40 to 42% of the origination would happen from affordable and emerging markets. So the idea of 17% is that keeping this in mind, number one. And number two, with respect to asset quality, we want to be one of the best in the industry in next few quarters. So the idea of 17 was to ensure that we grow in all the 3 segments and try and leverage opportunity on high yield segments.
Right. And if you are able to scale up the corporate piece, as you mentioned in the second half, does this growth that is kind of take that also in the account, or there could be some
this growth
lever?
No, this growth is on retail, what I mentioned. So corporate would be separate.
Right. And basically on the recovery pool, correct me if I'm wrong, like the broad numbers were around 1,200 crores is what you had written off on the corporate side, and some another 500 crores is there on the retail side. If you can give us like visibility of, I understand like of course we won't have visibility in terms of timeline precisely to guide, but just your assessment of what's the potential pool of recovery. It can happen either over a, say, 1 year period or a year period, but just a sense of it.
So, as I mentioned, recovery has already started. It started from Q4, and this will continue from this quarter onwards. I think at least this will play out in the next 4 to 6 quarters time on both corporate and retail.
And what would be the like kind of the recovery? Like, should we assume say 50 cents to a dollar, or how could it look like?
I think every quarter we will have support of recovery from the write-off pool, both on retail and corporate. In terms of corporate, it's difficult to quantify every quarter. In terms of retail, we will have, you can see numbers almost similar to what we've done in quarter.
Right. But actually what I was looking at is on the corporate piece. I'm sure you would have done an account by account analysis. Again, not asking for like what's the timeline and extent of it, but just a broad picture of like what could recovery look like, say, over 3 years, just on a cent to dollar basis.
So this is what I was trying to say. FY25, the credit cost is going to be continuous, and this does not take into account the write back. And in terms of write back, we can look at the number what you've done in Q4. This might play out for next 4 to 6 quarters time. On corporate, it is difficult to tell quarter on quarter, but I think in a year, we will see a good amount being recovered.
Fair enough. Maybe I'll connect separately after this. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. So firstly, on the overall disbursements yield, if we have to look at it across the 3 segments, would it be fair to assume that maybe the prime would be somewhere closer to 10, 11, or maybe 9, 10 odd %, maybe emerging market somewhere around 10 to 11, and affordable in 11.5 to 12 odd % range?
Yeah. Yes, you're right.
Okay. So when we look at the overall disbursement yields, okay, then obviously maybe there would be a component of the non-housing. But currently, when we look at the disbursement yields, particularly in the individual housing, then that should very closely resemble to where our prime would be. That would be closer to 10 odd %.
Yes.
Oh.
And also one more thing on affordable. On affordable, last year the yield was about 11.6%. In FY25, there will be 100 bips lift in terms of yield on affordable. So we are looking at 12.5 to 12.6.
Okay. 12.5 to 12.6. Yeah, because last time maybe that slide shows it somewhere around closer to 11.5, 11.6 all through.
Yeah.
Yeah. Okay. And when we look at it in terms of the branches, okay, so outside of affordable, we still have like say added almost like 30 odd branches during the quarter. Maybe carving out what we have highlighted over a period, 90 odd branches would be prime and 50 odd branches would be the emerging market. So these incremental branches, are they more towards the prime segment or the emerging market? Because currently there is no breakup which is there.
So I think broadly we opened 100 branches between December to March. Out of 160 is in affordable.
Yeah, affordable. Yeah, and balance 40. Yeah.
60 in affordable, and out of the balance 40, about 22 in emerging, and the balance 18 in prime.
Okay. Okay. And lastly, in terms of the incremental borrowing cost, so I presume, given that last time we have withdrawn, drawn down around about 800, so balance in the NHB would have come in this quarter?
Yeah, we have drawn full
Almost
amount.
so 2,200 would have been drawn down this particular quarter. But still, when we look at the incremental borrowing cost that's moving up compared to that of Q3, and NHB would have been at a much lower cost. Now, so is it like more kind of a CPA repricing impact, or how should we look at it? Yeah. There is still a 10 bips kind of increase in the incremental cost of borrowing despite a larger part of the increase in borrowing through NHB.
Yeah, it is, Kunal, because of the tighter liquidity conditions in Q4. Generally, the market remains tight in liquidity during Q4. This will start improving from Q1 onwards.
Okay. But still we are saying that margins would still come off despite maybe I think because incremental also it should come off a bit in terms of the overall borrowing cost. And we are maybe increasing the proportion of emerging as well as affordable. Then maybe we are guiding for 15 bips kind of a decline in NIMs.
Yeah, see, NHB will not be there in Q1, right? So that is, we have to work on the existing instruments. Plus, as sir mentioned, there would be some BT and repricing pressure on the existing prime book. So initially we might face some pressure, and hence it might stabilize at 3.5. And then with the higher improvement and higher mix of Roshni and emerging and corporate coming in, later half it will start.
And also, to a significant extent, we draw down from NHB in Q4. So if you see the impact, it will be hardly anything in that particular quarter.
Okay. Okay. Got it. Yeah. Thank you.
Thank you. We'll take the next question from the line of Nilesh Shah from Julius Baer. Please go ahead.
So, just starting once again, from a glide path point of view, say, about 3-4 years from now, where do you expect your segment mix to land up between corporate? Sorry, I'll try once again, else, I'll get back to you.
I got a question.
Yeah.
In about 4 to 5 years from now, I think,
where do you expect the mix to be between affordable, prime and...
Yeah, I got a question. In about 4 to 5 years from now, on the corporate side, we want to keep it in single digit. So, it's going to be less than 10%. So in about 4 years' time, between affordable and emerging, we would like to reach at a book level of about 40 to 42%, and the rest would be from prime.
I see. Okay, great. Follow up. Sir, now you have a mix of branches, right? What you have done over the last 2 years is you have created standalone of branches.
Sorry, you're
right?
not audible.
Sir, are you able to hear me now?
Sir, you are not audible, not able to hear you properly.
Okay, I will go back in the queue and hopefully my actually on the road, hence the issue. I'll go back in the queue.
Sure.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Thank you for the opportunity, sir. My question is regarding what is the EM growth, the loan book growth that we are targeting for FY25?
17%. 17% retail.
Okay, 17% on the retail side. And sir, also on the corporate side of it, so if I understand it right, we are planning to restart this corporate lending activity from H2. So, so are we going to bring the book down to zero before that, or would it be stable around this levels only?
So I think we would start this year sometime in the beginning of H2. So by that time, this book couldn't have become zero. So I think it may be maybe a couple of hundreds lower from the current level. That's all.
Oh, okay. Okay, sir. That's all from my side, and all the best.
Thank you.
Thank you. We'll take the next question from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Girish, you have cleared and cleaned the balance sheet since you have did very hard work. Now, we want you have good capital adequacy below 1% NPA. Now, what is strategy to grow in financial year 25-26 in percentage term, if you can tell something about the figure?
Okay. In terms of growth guidance, we are looking at 17%. The reason why it is 17, why it's not more, is simply because we are now moving towards high yield segments. So we were only we were largely in prime and super prime earlier. So last year we started affordable, and overall contribution was about 10% incrementally. And this year we've started emerging. So which is why we want to ensure that we grow profitable book and not just the book. That is why we are focusing on 17%. In future, if you see an opportunity, and this number could change.
Okay. Thank you very much. This is my question.
Thank you.
Thank you. We have a follow-up question from the line of Nilesh Shah from Julius Baer. Please go ahead.
Hi, sir. Are you able to hear me now?
Yes, we can hear you. Please go ahead.
Okay, great. I just stopped my car. Sir, just wanted to ask, sir, what you are trying to build here, where you have inside one company, a set of branches and people catering to prime, and a set of branches and people working double, right, sir? What our experience in India has shown us that actually, both the go-to market, right, in terms of the kind of branch you need to have, where you need to have, how you access customers, and the business processes are very different, right? And I understand that, you have had a business process that is oriented thus far for prime. Now that you want affordable to become 40-50% of your book over the next 5 years, how would some of these things have to change, or would you create a new set of processes, rules, right, for the other segment? And, is it possible to have two sets of employees like that inside a company? And are there, in your experience in doing this over the last 1 year, how has your experience been, basically?
Sure. Thank you for the question. Yeah. So, actually it is not affordable. Affordable and emerging both put together in next 4 to 5 years at a portfolio level, we would ideally want to be around 40%. So that's the first point. Second, in terms of affordable and prime, these two are two totally different businesses. Whether it is customer segmentation, whether it is the geography, whether it is a given pocket in the town or the city, whether it is the type of collateral. So I think it's very different, and even the process and the risk controls what we need to have are very different from these two. Now, between prime and emerging, not much of difference. There is a difference, but the difference is very less. And therefore, both prime and emerging could be, even though, these are two different verticals, we have set up different teams. And therefore, the nitty-gritties are very different compared to prime and affordable. Therefore, number one, on the affordable side, we have very carefully chosen the geography and the pocket within the given town or city to ensure that our branch would cater to customer segments and the kind of properties we cater to. That's number one. Number two, the entire team on the affordable side, they have experience in doing affordable business. And two, because we have a slightly different process for affordable and prime, we have a different dedicated team on the affordable side. We have a dedicated sales team, dedicated credit team, dedicated ops team. So it's very different. And therefore, it is very important that we need to have a different team to manage different businesses. Because the need and the opportunity what is available in this country is very different depending on the customer segmentation. Therefore, we have different verticals to manage different set of businesses. And our experience on the affordable side has been very good and very encouraging. However, initially in the first year, we were not operating in all the segments because even though the team is from affordable segments, even though we had done a thorough research before selection of branch, in the city or a town, we thought let's understand the market better and let the team also, get used to PNB housing culture and the processes. Therefore, we went little slow in terms of opening up all the segments. However, after Q3 onwards, we started, looking at all the segments, and that is why now we are ready with increased set of branches from 100 to 160 to operate in all the segments within affordable. So these two are very, very different business. You rightly pointed out. Everything is different. Customer segment is different. Branches are different. Geography is different. The products are different. Type of collateral is different. The orientation is different. The kind of risk controls what you need to have is very different. And therefore, we have dedicated specialized team to manage different businesses.
I see. Sir, just one follow-up. Sir, from a ROA point of view, you are, what we hear from you is confidence on the NIM path improving because of this emerging plus of affordable mix going up, right? But we haven't, don't you think that the OPEX of this would be significant? And even from a, OPEX point of view, at a branch level, and affordable branch also has a journey, right, in terms of breaking even because the loan ticket sizes are smaller, right? Don't you think that the OPEX cost would significantly increase, and therefore, at least in my mind, I'm not, perhaps you could comment on what impact of this transition would have over the next 2 years as you increase the share on the ROA, right? Primarily because of OPEX and the credit cost line, which will sort of worsen because of this mix.
On the OPEX side for prime and emerging, not much of difference. On prime and affordable, there is going to be some difference, but for PNB housing, most of the verticals other than sales, credit, operations and collections are shared. Number one. Number two, we have seen the experience on the affordable side by opening 100 branches, and all the 100 branches are now, with a decent vintage. And we have seen the OPEX on that. So, we already have an experience of 100 branches. So, OPEX on the affordable is going to be slightly higher. But if you look at the break-even of the branch on the affordable side, it should happen in about on an average of about 8 months or so. So now we have crossed the bridge to the extent of about 65 to 70%, and we have an experience on what kind of business we can generate, at what yield, and what is going to be the OPEX. And that is the reason we were very confident. That's the reason we opened 60 more branches on the affordable side. So, to answer your question, OPEX for affordable is going to be higher compared to prime, but the difference in our case is not going to be substantial. It's not going to be significant because we have most of the shared resource which would cater to all the three. For example, we have the entire IT infrastructure, the call center, all of these things are shared. So we have to only dedicate certain teams to do this business, that is sales, credit, operations, and collections. And therefore, for a standalone affordable company, if you look at the OPEX, for a standalone prime company, if you look at the OPEX, there is a huge difference. For us, it is just one segment within the overall enterprise, and therefore the OpEx is not going to be significantly higher in affordable compared to prime or emerging.
Okay. I mean, overall, what is your company level ROA guidance over the next 1 or 2 years? Where do you expect it to go versus the FY24